William Scholes, the Aberdeen Israel Fund, is up over 11% so far this year. So what's driving it? Why is now a good time to own Israeli stocks?
Well, in terms of the fund itself, it's trading at a 12.5% discount, so you're getting 100 cents at assets for 88 cents that you're paying. The economy is at an interesting stage now with the new cabinet sworn in, and we think at the end of a regulatory tightening cycle, we think it's going to be positive for businesses. We also think the economy is in good shape. Unlike many other of the faster growing economies, Israel doesn't have structural imbalances that make it more vulnerable to a Federal Reserve rate hike. So actually we view the economy as strong and growing fast and offering still good value.
And about a quarter of your fund is in Teva and Perrigo. They're doing their own little merger dance. Can you give me your outlook for these two companies?
Well, as you say, the proportion of the fund has grown as these stocks have risen amid the merger speculation. I mean, our outlook is regardless what happens with the mergers themselves. At the moment, it's unclear which way this is going to go, but we still think these are strong businesses. We think the growth of a very profitable generics business offsetting the decline of Copaxone at Teva is encouraging, as is their anti-migraine developments. And for Perrigo, I think the investment case both for their prescription business and for the consumer healthcare side, again, is a strong and encouraging trend. So I think we're positive on both.
The other big weighting in your fund is in information technology and cybersecurity. Clearly, there's a lot of hacking going on, so this should be good for companies like Checkpoint Software.
Absolutely, and Checkpoint is recognized as one of the leaders in network security software. And I think one of the things that underpins that, and particularly makes it attractive from our point of view, is that continued sales into their installed base, so the level of recurring revenues, makes their business model a very visible one. And they are highly cash generative. They have more than 100% of their equity in cash. They return cash to shareholders by significant buybacks every year. So it's a company with strong industry vectors, but also very strong stock-specific attributes.
And you mentioned that because this is a closed-end fund, it trades at around a 12.5%, a 13% discount to its NAV. But in general, do you think Israeli stocks trade at a discount because of geopolitical issues?
Well, it's an interesting one. I mean, the forward earnings multiple for the fund as a whole is about 16 times PE, and that compares to the consensus estimates nearer 10 times. That's a substantial, what we call a quality premium. But Israeli stocks, what I would divide the fund up into is the higher rated, largely US listed stocks, which are trading nearer 20 times PE, and some of the domestic peers, which, as you say, do come a bit cheaper. So for a lot of the companies focused on domestic economy, particularly consumer staple stocks, some of the financials, those are at a discount. But if there is a discount for geopolitical reasons, I think that's harder to say, and I'm not sure it's substantial if indeed there is one.
All right, thanks a lot, William.
Thank you very much.
And thank you for watching The Street.